Critical signals from the Federal Reserve's recent meeting. Recent minutes from the Federal Reserve's January meeting contained significant information that Americans need to understand. Despite general consensus among financial commentators that interest rates would decrease, those minutes revealed discussions among Fed officials about potentially raising rates instead. This contradictory message indicates a more unstable economic situation than publicly acknowledged. After 3 consecutive rate cuts in late 2025, expectations were set for continued reductions to make borrowing cheaper. However, instead of further cuts, the Fed decided to hold rates steady at 3.50% to 3.75% during their January meeting. Some officials expressed support for raising rates if inflation remains above the 2% target, signaling a possible reversal in monetary policy that contradicts current market expectations. The economic landscape presents conflicting signals. Strong employment data shows a stable labor market, with January payroll numbers exceeding expectations and unemployment dropping to 4.3%. Conversely, inflation remains stubbornly high, with the core consumer price index at 2.5%, which still exceeds the Fed's target. Many analysts have warned that inflation might rise again, affecting future interest rate decisions. The financial implications of rising interest rates are severe. Currently, Americans hold approximately $12.6 trillion in mortgage debt, and even a modest increase in rates could push mortgage costs above 7%. This would significantly impact monthly payments, making homeownership increasingly unaffordable for many families. Consumer debt, including credit card debt, auto loans, and student loans, exceeds $17.9 trillion. If rates rise, servicing this debt becomes more expensive, straining household budgets. With delinquency rates already on the rise, increased borrowing costs could push more families into financial distress. The political implications are also concerning. The glaring disconnect between the White House's demand for lower rates and the Fed's deliberation on potential increases poses risks for the financial system's stability. The Fed's independence is crucial for maintaining the dollar's credibility. If political pressures influence their decisions, it could lead to spiraling inflation, as seen in other nations with poor monetary policy practices. The Fed faces a challenging contradiction. If they cut rates to appease political figures, inflation could reignite, undermining the progress made over the past 2 years. On the other hand, maintaining current rates means continued pressure on consumers, risking economic stagnation. These complexities underscore that the financial relief many have anticipated may not materialize. With uncertain economic conditions, consumers must prepare for potentially higher borrowing costs instead of the anticipated cuts. This situation could harm personal finances, from mortgage payments to retirement accounts. As the Fed's January minutes highlight critical discussions, it serves as a warning that economic recovery may not be as predictable as hoped. Observers should recognize the potential for sudden shifts in monetary policy that could have far-reaching consequences. Those proactive in understanding these signals will be better positioned to navigate the upcoming economic uncertainties.